Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. BHP this week turned in a disappointing underlying profit of $8 billion for the second half of last year. It also cut its dividend to its lowest level in 8 years, with weaker demand for steel out of China hurting BHP's iron ore exports. But increasingly, for BHP at least, the future is in copper, a theme that certainly comes through in today's interview with Vandita Pant, BHP's Chief Financial Officer. She spoke this week to our partners at Ausbiz, Australia's leading provider of live and on-demand video of the latest news in Australian business, markets, economy and startups. Sign up for free at ausbiz.com.au.
Well, let's get more into those results then, Vandita, because underlying profit was down 23% and your dividend at an 8-year low, in fact, the bare minimum in your shareholder policy. Can you talk us through why that is?
Yeah, let me talk through the results, Juliette. Financially and operationally, both very strong performance. From operations perspective, volume was up 5%, and as I was saying, cost down 4% at unit cost level. Western Australia Iron Ore continued to be the leading iron ore business in the world. BMA in Queensland, production up 14%, and copper this half grew 10%, contributing 40% to EBITDA. All that delivered a net operating cash flow of more than $8 billion this half, which on run rate basis is more than $15 billion that we have generated in all bar one of the past 15 years. This stability is really the hallmark for BHP and really valued by our investors. The dividends that we have declared are 50 US cents per share. That's 79 Aussie dollar cents. That is $2.5 billion US dollars. And we have continued to prosecute on our attractive organic growth options. From a dividend perspective, I would say since our capital allocation policy was put in place around 8 years back, we have returned 83 billion US dollars in cash returns to our shareholders. But equally, we are a long-term company and so are our shareholders. And on their behalf, we are investing in growth on commodities like copper. Like I mentioned, while WAIO continues to be a fantastic business for us with lowest cost in the industry for the 5th year in running, we also have a copper growth now coming through in these results with 40% EBITDA contribution. And this is just the start because we have a fantastic area of very attractive investment opportunities for copper here in Australia, in Chile, Argentina, and in the US, and all that we are going to be investing in for value for our shareholders, while being very cognizant that dividends are really important to our investors. And that's why we have at least minimum 50% payout ratio as a policy.
So does that mean that you see more of a reshifting of the business to assets like copper and potentially away from iron ore from Western Australia to places like Chile?
So what I would say is that iron ore is a fantastic business for BHP and continues to be and will be. And in fact, we, as I mentioned, not only are the lowest cost producer, last financial year, we generated $8 more in cash per ton of iron ore compared to the nearest competitor in Pilbara. But equally, as per our strategy, we have the aspiration for more and more future-facing commodity exposure in our portfolio. And copper is that commodity with multi-uses, with demand and supply dynamics which are very positive, which has positive outlook, and we are the largest resource holder of copper in the world. First or second producer of copper in the world, and now by end of June, we would have delivered 24% growth in last 3 years just on copper. A fantastic place to be. And some more growth, as I said, to come. And that is an exposure we are looking to add. And I should also mention we have potash business in Canada, which again is going to be producing its first tons by end of next calendar year, will come in at the lowest end of the cost curve and is a multi-decade asset, which will be generating lots of cash and returns for our shareholders. So very excited about our growth portfolio and the portfolio shaping that is happening.
Vandita, no major changes to guidance expectations over the full year or the medium term. I just want to get your thoughts, though, when we talk about iron ore, with the weakness of the price and the expectations that the commodity could fall under further pressure in 2025, especially as we look at the concerns over a potential trade war between the US and China and how that could affect your business.
Yeah, so iron ore, very important. And for that, China outlook is an important consideration. Last year, most of the sectors in China did well, had growth, be it infrastructure, machinery, transportation or exports. But construction continued to be a drag and a weakness. But China still produced 1 billion tons of steel. Now where we are seeing some early recovery signs, even on construction, which means it may be a less of a drag this year. This includes, for the first time in last quarter, national housing sales turning into growth for the first time since the end of 2021. Equally, the government is taking a very pro-growth policy stance, both fiscally and on monetary policy, to stimulate the local economy, boosting local demand, as well as to rebalance the economy going forward. And I think that would be especially true if there were headwinds on tariff. So broadly speaking, we are again expecting another billion tons of steel production out of China for the 7th year in the row in 2025. And the growth overall for China to be 4.5% to 5% this year and next year.
When we look at the share performance, and I know you can't control the market, Vandita, but it wasn't the resources year in 2024. A lot of analysts saying that there should be a switch in 2025 from the likes of the big banks into the miners. Do you have anything to say about losing your mantle as the biggest listed stock by market cap to the likes of CBA?
So as you said, not looking at the share price on a daily basis, but what I can say is that I'm very excited about the financial, operational, and execution capability that we are showing in delivery of our projects. From our perspective, the portfolio is doing very well, generating industry-leading margins, rock solid return on capital of 20%. We continue to be the lowest end of the cost curve for most of our commodities, which is important even if there were uncertainty in the external market, which means with the strong balance sheet, we're able to balance not just shareholder return, but also value-adding growth on behalf of our shareholders. So I think it's a great place to be in.
And how much is union infiltration impacting some of your growth plans? What do you say about productivity?
I would say that competition globally on resources, mining, investment is heating up massively. Every country is attracting investment, talent, capability through fiscal incentives, through very simple permitting processes, but also to high standards, through enabling infrastructure. And all these things matter, which means for Australia and for us in long term, being competitive on every count is really critical. The prosperity of the nation and the ability to take advantage of the opportunities that we have in our resources here is immense, and something that we need to make sure that we do not risk by having productivity becoming sluggish. Because if productivity becomes sluggish, the long-term standard of living and competitiveness of Australia and Australians becomes at risk.
That was Vandita Pant, Chief Financial Officer at BHP, talking to Juliette Saly on Ausbiz, Australia's leading provider of live and on-demand video of the latest news in Australian business, markets, economy and startups. Sign up at ausbiz.com.au. It's free. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.